huge gains on mutual fund investments and equity shares comes the pain of paying taxes on them. What if I give you some tips for saving tax on capital gains incurred? Hello and welcome. I am Namita, a tax expert at Clear. We are India's largest tax and financial services platform for individuals. In this video, I will give you a few tips that can help you to reduce tax on capital gain on sale of shares or mutual funds. As you know, long-term capital gains on equity shares or equity mutual funds are exempt up to 1 lakh every year. Gains exceeding Rs 1 lakh are taxable at 10%. Since there is a tax-free limit of Rs 1 lakh, you can try to book a minimum gain of Rs 1 lakh on equity schemes. Where you have large equity portfolio, there will be higher incremental gains. Therefore, if you want to pay low or no taxes, you need to ensure these gains don't build up beyond the tax-free limit. Here is how you can smartly do it. For example, if you have invested Rs 1 lakh in the units of equity-oriented mutual funds in financial year 2018-19 and during the financial year 21-22, you see that the value of those units has risen and now its value is Rs 1,95,000. Further, you feel that the market is performing well and so the funds would, and its value is going to increase further. As per your estimates, the gain on equity-oriented mutual funds will exceed Rs 95,000 and it may cross Rs 1 lakh. As mentioned earlier, long-term capital gains on equity mutual funds are taxed at 10% on gain exceeding Rs 1 lakh. You can save tax if you sell those units of mutual funds before the profit crosses Rs 1 lakh. After selling, reinvest immediately at the same NAV. This strategy of redeeming and investing freshly will avoid tax. However, it is extremely essential to reinvest the money immediately. Otherwise, it will get spent or invested unfavorably. That way, the strategy loses its purpose. You can use another strategy to reduce taxes. That is, you can use capital loss in a particular year to adjust taxable capital gains. Let us say that in a year, you have incurred long-term capital gains of Rs 2,50,000 from a particular equity mutual fund investment, and for this, you need to pay tax on Rs 1,50,000. That is, after reducing the tax-free limit of Rs 1 lakh from the long-term capital gain, at the same time, you have incurred a capital loss of Rs 1,20,000 from another fund in the same year. Then this loss would be adjusted against the taxable long-term capital gains of Rs 1,50,000 from the previous fund. Thus, you have to pay tax on net capital gains of Rs 30,000. Moreover, if the loss is completely adjusted for a particular financial year, the losses could be carried forward for 8 subsequent years to reduce tax on capital gains. That is, suppose you incurred a short-term capital loss of Rs 40,000 in 2018-19 and could not adjust that loss during that particular financial year. So you can carry forward that loss for 8 subsequent years. Now, if you have booked long-term capital gains worth Rs 1,80,000 in financial year 21-22, while calculating the taxes for that financial year, you can adjust the brought forward loss of Rs 40,000 from Rs 80,000, and that way the net amount taxable would be Rs 40,000. You can do this for both debt and equity mutual funds. To know more about set-off and carry-forward rules, you can refer to our playlist. This is a good technique for taking advantage of lows in the market and reducing the tax outgo. This method can increase the net returns on the portfolio. The best thing is that even a bad year can add to the portfolio's value. Please note that you can carry forward the losses only if you have filed the ITR in the year of loss. So is it now clear why is it important to file ITR even though you have incurred a loss during the year? Please comment clear in the comment section below and file your ITRs to take all such advantages. In case you are planning to buy a residential house and you do not own more than one house, you can plan your long-term capital gains on shares and mutual funds in such a way to avail exemption under Section 54F for long-term capital gains, in case you are sitting on huge unrealized long-term capital gains. For example, if there is huge long-term capital gains during the financial year 21-22 and you are planning to buy a residential house during the year, you can invest the amount received on redemption of funds for the purchase of a residential house and claim exemption under Section 54F. Let's take an example. In financial year 21-22, the sale value of 5,000 shares of ABC company is Rs 36 lakhs. The purchase cost of same number of shares was Rs 28 lakhs in the financial year 2018-19. So the long-term capital gains on sale of equity shares in financial year 21-22 will be Rs 8 lakhs. And tax on long-term capital gains is 10% on gains exceeding Rs 1 lakh. That is Rs 70,000 in this case. Please make a note that if you don't reinvest the amount by the last day of filing the return, the balance amount should be deposited in the capital gain deposit account scheme with your bank. The income tax rule says that you can purchase one residential house within 1 year before or 2 years after the date of transfer, or construct one residential house within 3 years from the date of transfer. To know more about capital gains exemption, you can refer to our page given in the description box below. So folks, this is all about tax savings on capital gains. If you have any questions related to income tax, please comment below. We will reply to it as soon as we can. I hope this was helpful. Thank you for watching this video. Stay tuned for more updates. Take care and goodbye.